Greetings. I'm Randy Carver, President, Founder of Carver Financial Services. We work with a lot of business owners, and business owners have many unique needs and challenges. Today we're chatting about some of the potential risks and opportunities for you with regard to retirement plans. As a business owner, you know it's not what you make that's important, it's what you keep. You also know how valuable your time is. We appreciate you sharing a few minutes with us today and look forward to showing you how to save some time and reduce potential liability going forward. Retirement plans are necessary to attract and retain employees and can certainly benefit you. They're often also a hassle, and they can expose you to liability, be expensive, and pose risks to you both personally and as a business owner. Today we're going to chat about how you can mitigate some risk, reduce some cost, and personally benefit from some new developments. Joining me is Dan McGinnis from Carver Financial, who focuses on retirement plans for small business owners in our practice. We are going to cover a lot of important information today, and you can always reach out to us with any questions or any concerns afterwards without any cost or obligation. So Dan, how do business owners keep more of what they earn and stay out of trouble with regulators while minimizing the time and money that they have to spend?
Well, Randy, it's really interesting you ask this because business owners are obviously busy running the business and myopically focused. And unlike some very large firms who have a team of people that come in every day to run benefits and retirement plans, that's just not a practical application or viable in the smaller or even mid-sized business market. And frankly, that's why they often seek out assistance of experienced professionals. The tried and true way to help business owners keep more of what they earn is having a well-designed modern ERISA plan for their business that helps obviously benefit all their participants, which is great for employee retention. In this challenging job market, that's really important. But a well-designed ERISA plan that might include some advanced features like safe harbor 401ks, new comparability profit sharing plans, and maybe even cash balance plans, which we've been seeing a lot of lately, could be very attractive. One of the most obvious benefits of these plans is the ability to move thousands of dollars from the taxable pocket to the tax deferred. Obviously, helping them keep more of what they earn and pay less in taxes, but there's also other benefits as well.
So that's kind of interesting. So tell me about some of the potential tax benefits that you're insinuating here.
Well, Randy, we don't give tax advice, of course. We do pretty in-depth tax planning, but if you can save money out of the taxable pocket of that business owner's pants and into the tax deferred pocket, obviously it's not taxable income. So like you said, you can keep more of what you earn. So what does that do for the business owner ultimately? It lowers their reported adjusted gross income. And if we're paying attention here, working with their tax professional, if we get their adjusted gross income below certain thresholds and phase outs, then they may be eligible for a qualified business income deduction under Section 199A by the 2017 Tax Cuts and Jobs Act. Now, I don't want to get too complicated here because this is really something for the tax professionals that work with the business owners, but I would ask the business owners online here, do you know what your 199A qualified business income deduction was in 2021? If the answer is no, it may be worth discussing that with your tax professional.
All right, so that sounds good. Well, there's something called an investment policy statement, and that's obviously good practice and it's not required by the Department of Labor. What's your position on having an investment policy statement both for the business owner and for their plan?
Well, you nailed it. It's most important for the business owner and any fiduciary at the company. So the DOL does not require an investment policy statement. But the investment policy statement is a document, it's like a blueprint. So it's a document they're going to ask for anytime they do a random review or audit your plan. And that's not just the Department of Labor, that could be the IRS as well. So the first thing they're going to ask for, and we've been through several audits with clients in the past, 401k plans, 403bs, can I see a copy of your investment policy statement that outlines how you go about investing and what ultimately you're trying to achieve for your employees and their ability to grow and manage their retirement assets? A bad answer to that question is I simply don't have one. And that's really going to be a red flag for these auditors. So if you're prepared on the front end, it's only going to help things if and when you do get audited. The other thing with the investment policy statement is they want to see documentation along the way. So in addition to that IPS, they may ask for meeting minutes. So you want to be reviewing the plan over time, and they want to see documentation on have changes been made, why have they been made, stuff like that. So a horrible answer to that is we don't have any minutes. We have no record of what we've been doing. So you get where we're going here. I mean, the DOL or the IRS doesn't tell you that you absolutely have to have one, but the first thing they're going to ask for when they come in and look at your environment, even if it's randomly without any red flags. So the recommendation here is you absolutely have to have one. The only thing worse than not having an investment policy statement is having a very rigorous one, and it just simply isn't being followed. So it's important to have it reviewed periodically because businesses change, needs change, and the marketplace changes over time too. And no small business really has the prudent expert or folks on staff with the credentials to act as an investment fiduciary. So we do feel that the investment policy statement is critical.
So obviously, a lot of businesses don't have the experts on staff. That's why we have folks like you and third-party experts that help our clients both craft the policy statement and, of course, make sure it's something they're going to comply with. Now, Dan, you talked about the DOL here, or Department of Labor. What's the real risk to a business owner as far as that goes?
Yeah, it's a good question, Randy. Why don't we pop the slide up? We can go through some numbers from 2021. This shows the Department of Labor tagged American businesses for some $2.4 billion in fines and penalties. Now, if you'll notice here, a very small subsection of those were actually criminal issues. So a very small percentage of that was a business owner absconding with an ERISA plan money and off to some far-flung destination on a beach. Most of them were simple errors and omissions because the business owner did not have a dedicated advisory support organization behind him that understands the risks. It's like watching the poor Buffalo Bills lose a game with 15 seconds left. We knew they were going to throw the ball, so all the defense did was head to cover. We knew what the play was going to be. We know what the playbook is for the Department of Labor and can help business owners and their teams navigate this. We can assist with reviewing documents and updating all the things like making sure that employee deferrals are getting in on time, making sure there's an investment policy statement that is complied with, et cetera, et cetera. We know what the playbook is, so if they're working with an experienced professional, they should be in good shape.
So it's clear that business owners are dealing with a lot of regulation and regulatory agencies, and we can see what the top concerns are and plan for them. So DOL's top concerns, number one is late deposit. This is really simple. The money just doesn't go in a timely fashion, something that can be avoided, but surprisingly, a lot of businesses get fined over. Second one, excessive service provider fees. A lot of business owners aren't even aware of what they're paying and should really benchmark their plan at least every couple years against other plans. Imprudent investments, where the investments just aren't suitable for the participants. Of course, plan sponsor bankruptcies, abandoned pension plans, hard to value assets, where the owner or someone in the firm puts assets in that are very difficult to put a value on, like privately held real estate. And of course, the final one is fiduciaries that just don't know or fulfill their duties. And in fact, a lot of people aren't aware that they're even fiduciaries. Now, the IRS has some different issues. And again, this is more technical, where the plan doesn't fulfill proper documentation on a termination, whether it's a merger or acquisition with the company, how the plan performs with regard to testing, what's called non-discrimination testing, looking at how compensation is structured, and if the plan is suitably designed not to over defer or overly put assets away for selected individuals. Again, failing to file in a timely manner is a big one, something that's easily avoided. The application of vesting schedules, how loans are handled, plan fees, and again, looking at the expenses both internally and externally as far as provider fees, excess salary deferrals for key people, and then finally, a lack of controls internally and using the wrong data to file the IRS 5500. Now, there are other risks too. So Dan, what are some of the other risks you feel advisors or business owners are subject to?
Yeah, well, there's one that's often overlooked, and a plan is its own taxable entity, and it has its own tax filing. It's called a Form 5500. I would ask all business owners online, are you signing your own 5500? Because if you are, the answer is stop. When you sign the 5500, you're saying, hey, Department of Labor, I'm the fiduciary on this plan. And the Department of Labor says, well, bless your heart, as you would say in the South. That means that your personal assets can be included in any type of restitution should there be one of these errors and omissions or plan failures that would occur. Your personal assets, Randy. So when you sign that 5500, you're pledging your own personal assets behind the running and the management of the plan, which if you don't have the right partners on the top, can be a real risk or liability. And we see it all the time. A lot of times we'll talk to folks and they don't even know if they're signing the 5500 or not. So it's critical that you check and you make sure you have the right team in place. With that, someone else in the organization, such as the CFO or chief everything officer or whoever is paying attention to the plan, is signing that. And I bet you, if you do that, if you delegate that responsibility, folks will pay a lot more attention to who they're hiring and who's managing that plan and making sure they're getting the support they need to minimize these risks. There is a lot of risk here. We talked about $2.4 billion in 2021, and that's no joke. You can put away a lot of money, you can keep more of what you earn, but you have to have real professionals managing these plans.
So that's a great point about the personal liability. And Dan, our business owners, one of the things that they're always looking for is efficiencies, reduce cost, time efficiencies. Any ideas there?
Absolutely. There's a lot of new opportunities in the retirement plan landscape as a result of the Secure Act that was passed a couple years ago. So there's some really interesting new opportunities, a couple types of plans. So we have refer to them as multiple employer plans, or MEPs, and now they call them pooled employer plans, where you can group smaller businesses together into one single plan and have one 5500 to streamline costs, number one. So they're saving more, and the time you're spending administering the plan, it's a home run. So if there's a business that's out there that's looking for time and efficiency, they should be looking to their investment fiduciary about your options that are available in this multiple employer plan marketplace to potentially reduce expenses and improve fiduciary liability. There's other areas now where there's something called a multiple employer aggregation plan, where you can actually elect to have a third party be the named fiduciary in the plan document and also sign the 5500, which removes that liability from the business owner, CFO, whomever it may be. So I think those are the best opportunities out there right now, Randy.
So that's great. I mean, the fact you can offload the fiduciary liability, obviously save your own time, is going to be of importance to a lot of business owners. Now, one of the things we continue to hear about is businesses having trouble finding good people and even losing some of their key people, which
Mhm.
yeah, it's a real risk to businesses. So any thoughts or ideas as far as how we can attract and retain people, as whether it's key or just in general?
Yeah, it is a big risk, especially in the labor market that we're in. The number one thing, as a business owner, if you have a key employee or employees, it's really to look at benefits for them. What's important to them. What may benefit them long term. What will ultimately keep them at your company. Why not go somewhere else? So we recently had an experience with a car dealership, for example, that came to us. They have multiple locations, pretty sizable dealership. Obviously, what is germane and important to the car dealer, it's their technicians, it's their service department, and those highly skilled technicians that are working on those great cars. So unfortunately for them, a couple of their team defected to another manufacturer, a competitor, and it snowballed a bit. So this multi-location dealer was in a bind because a competitor poached their key employees. So these folks didn't have any equity in the organization, so no ownership, obviously. It's a family owned dealership. They're not going to get equity. So what could they do? Well, in order to retain the existing technicians and to make sure this doesn't happen going forward, we created what's called a non qualified compensation plan, deferred compensation plan for the business. So this is slightly different. Um, Randy, it doesn't help the business keep more what it earns today. These are after tax contributions that are made to the business, but they help the business keep their key employees. So it's really a retention strategy, and you can attract other folks if you're trying to hire as well. So it could be a recruitment tactic as well. And these plans were designed so that the benefits that were given do not vest for several years down the road. So the long story short, Randy, there are some interesting strategies to lock in some of the key employees you just can't afford to lose. So each situation is different, and we can help, or fiduciary can help design what is best based on your business needs. By the way, you can also choose which employees you want to include or provide those benefits. So there isn't the same non-discrimination testing like there is in a 401k or profit sharing plan. So you don't have to put everybody in it.
So that's great. You can obviously select who you want to include, and obviously where you spend the dollars for a business owner is a big consideration. So, what about the rest of the employees in the workforce? It's been kind of a weird time with COVID and everything going on here. What do you have to say about that?
Yeah, it has been. It's been a challenging time. We work with business owners to help them keep what they earn, like we've said, and help them retain their key employees, which is very important. And we can do that by providing good benefits. And the more important thing is actually educating the rest of the workforce, not just the key employees, about those benefits. So we call that financial wellness. And that's been a buzzword over the past few years because, frankly, there is a retirement readiness problem in the United States. And the Department of Labor, institutions like that are going to continue to try and improve that, for our citizens. So if we can have safe harbors in place that protect the employees, not just the key employees, I think that's a win-win. So we go in and you educate the employees on the benefits that the business owner is providing in the retirement plan, help them with investment advice, and then survey after survey shows that if you have employees who are financially confident, then they tend to call in sick less and are more productive. So whomever you decide to work with, as a partner on your retirement plan, you should have a financial wellness or employee education program in place. And I think that's really going to help, along the way in terms of really making sure people are engaged and educated and ultimately saving and taking advantage of employer match, things along those lines, Randy.
All right, so one final question, Dan. Can you touch base on Roth 401k and then something that's called Mega Backdoor Roth 401k?
Absolutely. Yeah. I mean, most of this discussion's been about tax deferred pocket. There's also a tax exempt pocket that's really important from a planning standpoint. and it could present unique opportunities, especially for business owners, because there are income thresholds on Roth IRAs. There are ways to get more money into a Roth 401k. We call that a mega backdoor Roth. And the plan provider, like a Fidelity, Empower, whoever it may be, has to allow for after-tax contributions. But ultimately, it's a way that once your tax deferred or tax-free contributions, because there are no income limits on Roth 401k, are maxed out, there's a way we can really maximize additional Roth contributions within the 401k plan, regardless of income. So there are a lot of unique opportunities to not only help business owners save more tax deferred, but potentially more tax free as well.
Hi, Dan. So, a lot of information for people. I want to thank you so much for your time. We appreciate everybody that's listening. Today, of course, the most important thing is to take action, whether you reach out to your current experts or you contact us. We're always happy to speak to you without cost or obligation and provide some insight in your current plan. At the very least, this will help you with any audits, as it'll help potentially reduce fiduciary liability. Also, it helps you benchmark where you're at, which is something that's very, very important. So, we appreciate your time, and we look forward to speaking with all of you very soon.